So you are sitting on a gold mine and you don't even know about this. The path to wealth is simple, and path to wealth worth 10 crore is simpler, but it needs discipline. So the unique combination of rising incomes in India's tier 1 city along with the country's strong economic fundamentals gives the young earners a very powerful advantage of accumulating wealth. So in India, we are seeing a unique combination where in the tier 1 cities like Bangalore, Mumbai, Delhi, Chennai, etc., Hyderabad, Pune, the income of young people are rising very fast. And at the same time, the entire country is seeing a very strong economic fundamentals rise, and that is giving a very powerful advantage to accumulate wealth to the people in their young 20s and maybe even early 30s. So India's growth trajectory, expanding markets, and accelerating innovation cycle is creating a rare window for long-term wealth building for young people, much like that of USA in the 50s and 60s, and like that of China from 90s to 2000s. So just like the way China grew from 90s till mid 2000s, or rather 2010s, and just like the same way USA grew in 50s and 60s, India is currently going through the same phase. It is beginning to go through the same phase where it is growing at very fast pace compared to the rest of the world. Its markets are expanding, all sorts of markets, and its innovation curve is rising as well. So as you might know, India's GDP grew by 7.2% in the last quarter, that is Q2 for the current financial year, which which is following its 7.8% growth in Q1, which is above all estimates in an increasingly difficult global geopolitical scenario. So as most of the world is going through some sort of economic problems right now, India has been growing at much faster pace than the rest of the world, and it has often been termed as the fastest growing major economy. Today, India has all the raw ingredients which can propel its growth for the next 2 decades. Those ingredients being a young, educated demographic, combine that with a very low GDP per capita, which results in a lot of very cheap, competitive human resource. And at the same time, the workforce is very skillful, very talented, very hardworking, and eager for success. Therefore, all of this combines to generate a lot of wealth for its corporates. As India continues to grow, as more and more people join the workforce, they will spend a lot more money, and so all sort of companies which are targeting the lower end of the demographic, companies which are targeting the mid end of the demographic, and companies which are targeting the top end of the demographic are all going to do a lot of business and make a lot of money, and therefore their shares are going to increase, and therefore their shareholders are going to make a lot of money in the next 2 decades. Now, what global history shows us is that when the economy, markets, and innovation curve are all working for you, not against you, but with you, it's better to take a long term value based approach rather than speculative in chasing quick returns. So, history shows us that those following long term value approach make way more money than those trading frequently or looking to time the market. You just need to believe in India's long term growth opportunity. So, here's a potential financial framework which you could use to build your own wealth. Now, save at least 50% of your monthly income. Now, it is much easier said than done. It's much easier for those who are in the high income bracket, especially those who are earning 1.5 lakhs to 2 lakhs and upwards of that figure in India. But even if you are in low income bracket, you could save a part of your monthly income. Even if you could save 10%, 20%, in 20 years from now, you would be much ahead of where you would end up without saving any money. So, this is the first step. If you could save at least 50% of your monthly income. Next, before investing, you should build up an emergency fund which is equivalent to 6 months of your expenses. Then when you begin investing after you have your emergency fund in place, then you can invest 80% of those savings into equities through a variety of instruments like mutual funds, index funds, or directly in high quality stocks, only if you know how to analyze a company. And then put the remaining 20% as FD for fixed income. Now stay consistent with this framework for 20 years and then see the magic. So, mathematics of compounding. So, let's say your investment gives you an average of 12% return per annum. Now, in the Indian stock market in the last 30-40 years, the index has given on an average 15% return. Therefore, it uh, becomes double every 5 years. And then you can add additional 1.5% of dividend yield. So, on an average, it gives around 16% of return. But we have a component of FD as well to diversify. Therefore, let's consider an average of 12% return. Let's keep a conservative approach here. So, for high earners in tier 1 cities, an investment of let's say rupees 1 lakh per month under this framework would become more than 10 crore in 20 years. So, you can Google for any investment future value calculator online and you get the calculators where you can put different parameters, different time period, the investment you'd like to do per month, rate of interest. You can vary all of these figures and see what would be the final value of your investments. So if you invest 1 lakh per month and let's say you are getting 12% return per annum, so in 20 years it will become 10 crore. Even for those who are not in high income category, those who are not so fortunate, but even if you save a meager 10,000 per month, this will result in a wealth of 1 crore at the end of 20 years, which is a lot of money. If you have a savings of 1 crore, and from that, uh, if you're just doing FD, you will be getting somewhere between 3 lakh and 3.5 lakh per annum. So that could easily break down to 30,000, an income of 30,000 per month. So those who are having difficulty in saving 10,000 today, in 20 years from now, you will be earning three times of that per month just by FD. Now, if you put that in the stock market, it could be growing at double the rate of that. And those who goes in this high income bracket, who have a net worth of more than 10 crore in 20 years from now, those people don't need to put a lot of money in the uh, bank FD. You can afford to take a lot more risk in the share market. So let's say 15% of or 12% of let's say 15% of 10 crore would be 1.5 crore, so you'll be earning 10 lakhs per month just by saving 1 lakh per month. But you need to have patience and discipline. You need to sacrifice today, live like nobody else, so later you can live and give like nobody else, as Dave Ramsey says. And it's not magic, it's just compounding doing its thing. And it's India's compounding opportunity. It's a defining opportunity for young Indians to build generational wealth and change the fortune of their family. In return, it needs just discipline, patience, and the power of compounding. So that's all for today's video. Thanks for watching.